What is a short-term small business loan? When most people think of a small business loan, they think of the traditional 5 or 10-year term loan offered at the bank. As a general rule, I'm of the opinion that borrowing should either increase the value of the business or facilitate an opportunity to capture additional ROI. A long-term loan is a good fit to finance long-term business needs, like purchasing a new warehouse, moving into a new location, or purchasing an expensive piece of equipment. Nevertheless, there are many loan purposes where the longer terms of more traditional small business loans might not be the best fit. Fortunately for small businesses, their local bank is no longer the only place to borrow. With online lenders like OnDeck, there are now financing options available for a variety of business purposes, and loans with shorter terms are available to meet the financing needs of shorter term projects. When should a business consider a short-term business loan? Before you apply for a loan, there are some questions you need to ask yourself to identify the right loan option for your business. The first question should be, what is the loan purpose? This is an important question and will help you determine how much you need to borrow, what term lengths could be the best for your business, and where should you apply. Depending upon the loan purpose, many small business borrowers choose a shorter term loan to minimize the total dollar cost of the loan and potentially capture additional ROI. According to a survey commissioned by the Electronic Transactions Association, 57% of small businesses would choose a shorter term loan in order to minimize the total fees, expenses, and overall dollar cost of financing. Because APR does not represent the total dollar cost of a loan, this was true even if the shorter term loan included a higher APR than the longer term option. In many cases, the APR of a short-term loan can be much higher than the APR for a longer term loan. But when you consider other factors, such as the total cost of the loan and your business need, a short-term loan can be a good fit for your business. A good rule of thumb is to consider the useful life of the asset being purchased to determine whether a short-term or a long-term loan makes sense. According to that same survey, 54% of business owners used this financing to purchase equipment and 51% to purchase inventory. Both purchases tend to be very dollar cost sensitive. What's more, these small businesses were anticipating a 5 times return for every dollar they borrowed, making the total dollar cost of the loan a key consideration for them. The most popular reasons to choose a short-term loan include project startup costs. There are times when ramping up a new project requires upfront costs that might exceed a business's ability to cover with cash flow, but will be recouped in 60 or 90 days as their customers pay their invoices. In that case, the ability to get in and get out of the financing quickly at a lower total dollar cost could make more sense than making payments on a longer-term loan for several years. Bridging a seasonal cash flow gap. Many seasonal businesses sometimes borrow to meet short-lived cash flow demands during lulls that exist between their busy seasons to cover expenses during the downtime. Doing so requires the business ensure that it has sufficient cash flow during that slow period to make the periodic payments required during the off time. Purchasing quick turnaround inventory at a discount. A short-term loan could be a good opportunity for purchasing inventory at a discount that will turn quickly and allow the business to capture additional profits. Cover the costs of emergency repairs of business-critical equipment. When equipment necessary to the operation of your business fails, a short-term small business loan can help get operations moving again without a 4-year or longer obligation. Why does loan purpose matter? Technology has changed the way we do just about everything, from purchasing traveling to hailing a cab. This now includes many small business owners and how they get a small business loan. One of the ways they're doing it is by focusing on specific loan types, loan terms, and other criteria that match particular business use cases. Most people would never buy a new car with a 30-year auto loan, and some small business financing options may be better suited to meet shorter-term business needs. For example, the type of loan a business would need to purchase inventory at a discount could be very different from the financing that a construction of the new warehouse would require. Sometimes it might not make sense to borrow for several years when the value of the asset you're borrowing has a much shorter lifespan, or ROI. Here are 3 more questions to ask yourself to help you decide if short-term financing is right for your business need. How much capital do I really need to borrow? Is there a lender that specializes in the type of loan I need? And what type of loan term makes the most sense? Another aspect you may not be considering is that a short-term loan from the right lender can also be a tool to help build a stronger business credit profile. If you work with a lender that reports your credit history to the appropriate business credit bureaus, this will help build a strong business credit profile. This is important enough that you should always ask to make sure that your lender reports your business credit history to the business credit bureaus, and if they don't, ask them to do so. As long as you make timely payments, that positive credit history will help you build a strong profile. This can be particularly valuable for younger businesses as it has the potential to help create additional small business loan options down the road. If you have any other questions on business financing, check out OnDeck's Small Business Center at ondeck.com/resources.